You've probably came across the term non-farm payrolls or NFP in financial news every month and wondered what, how, and why is it important to the markets? In this video, we'll walk you through the essentials of non-farm payroll and explain why you should add the data to your watch list. Stay with us until the end to discover how to identify trading opportunities surrounding this key economic report. Before we dive in, don't forget to subscribe and hit the notification buttons for the latest trading tips and insights. What is the non-farm payroll and what exactly does the non-farm payroll stand for? The non-farm report is a key employment data released by the US Bureau of Labor Statistics on the first Friday of every month. It measures the changes in the number of employed individuals in the US, excluding farm workers and a few other sectors. It covers over 98% of US workforce, which makes it a crucial indicator of the labor market's health. Now, why non-farm payroll is critical to traders? Now, why should traders pay attention to this report? There are two main reasons. First, non-farm payroll gives a near complete snapshot of the US labor market, which serves as an indicator of the health of the US economy, which makes it one of the key data that the Federal Reserve watches closely when deciding whether to adjust their monetary policy or simply what the market really focuses on, the interest rate. For instance, if the non-farm payroll report shows weak job growth, it could signal that the economic growth is restricted, which in return gives the Fed a reason to cut the interest rate to stimulate the economy. However, a lowered interest rate will weaken the US dollar, which brings us to the second point. Because the US dollar is considered the global currency, non-farm payroll data doesn't just impact the US assets, it also influences global markets, including currency pairs, gold, indices, stocks, and even crypto market. Even a small shift in the job numbers can cause significant market reactions, creating that one thing every trader loves: volatility. By tracking the non-farm payroll, you're not just monitoring the jobs data, you're gaining insights into potential interest rate changes and the broader economic outlook. Now that you've known why non-farm payrolls matters, let's talk to you about what data you should focus on in this report. In addition to the non-farm payrolls itself, traders also keep an eye on two other figures: the unemployment rate and the average hourly earnings. These numbers gives you a more detailed pictures of the labor market. If you look, for example, if the jobs creation is strong, but wages remain low and stagnant, the consumers have less spending power and therefore the inflation risk will be very low, which possibly signals no immediate rate hikes. The takeaway here: looking beyond just the headline of our payroll number can help you better anticipate how the Fed as well the market might react. Now comes the crucial question: how to trade based on the non-farm payroll data. To develop a solid trading strategy, you need to understand what to expect during the non-farm payroll data release. Not just only the actual results of the report, you should also pay attention to the market expectations. Generally, when the non-farm payroll results are stronger than expected, it signals a robust economy, which tends to boost the financial markets. However, context is key here. When the US economic growth is slow and the market anticipates a rate cut to stimulate the growth, a stronger than expected non-farm payroll report result could make a decision uncertain. This may trigger significant market reactions. While the US dollar is likely to strengthen, assets such as commodities, US stocks, and indices could see a decline, presenting selling opportunities for traders. On the other hand, if the non-farm payroll report results come in weaker than expected, the US dollar will likely to weaken and assets such as gold and stock could rise on expectations of a rate cut. But be cautious. If the non-farm payroll report is extremely weak, it could spark fears of a recession, causing most assets to drop sharply, except for safe haven assets such as gold. So the key to trading around the non-farm payroll report lies in understanding the data, the microeconomics, the environment, and the market sentiment on how to anticipate the market, and it will definitely affect your decisions. But before you trade right away, please be reminded that trading in volatile market is risky. A spike or a crash could happen in no time. Setting up your trading strategy before market entry is necessary to secure you from the risks of trading. If you find this helpful, make sure to like, subscribe, and stay tuned for more expert trading insights. Thank you for watching.